Chapter 12. VAT and other taxes. Value-added tax is a charge on the supply of goods and services by a VAT vendor. A practice with an expected yearly turnover of more than 1 million rand is required to register for VAT. The amount of VAT collected minus the VAT paid to the VAT vendors should be paid to SARS. Most firms submit a VAT return every 2 months. Output VAT is charged on all goods and services. There are 2 ways of calculating VAT. VAT vendors who are natural persons with taxable supplies not exceeding 2.5 million rand per year may use the payment basis. This means output VAT is accounted for when the money is received and input VAT is claimable only when the actual payment is made. All incorporated firms should use the invoice basis. This means that output VAT is accounted for when an invoice is issued or when a payment is received, whichever comes first. Input VAT is paid on all goods and services acquired from the VAT vendor and can be claimed on your VAT return. You may not claim VAT for expenses relating to entertainment, motor cars, salaries, wages, and expenses paid on behalf of the owner or partners. Output VAT for fees will be debited from the client business ledger and credited in both the fee income account and VAT control account. Input VAT for expenses such as telephone bills will be debited from the expense account and credited in both the creditor and VAT control account. Income tax is paid on the firm's net profit, which is the balance of the firm's income minus its expenses. Tax returns are submitted to SARS on a yearly basis and are charged at a fixed rate of 28% for companies. Incorporated companies need to register for tax in their own capacities, and sole proprietors can use their personal income tax number for tax submissions. This means that a net profit of 40,000 rand would amount to 11,200 rand of payable tax. Provisional tax is the payment of your annual income tax in 2 installments, one within 6 months of the start of your financial year and the other at the end. The first payment will amount to half of the tax payable on the estimated taxable income for the year. The second payment will be the tax amount on the actual income for the year minus the first payment. These payments are recorded by debiting the provision for income tax ledger and crediting the business account.